Well, I'm excited to be here today. I have been helping Danielle for 3, 4 years now, and it's been a fun experience. We've been able to work together and alleviate Danielle's time and help her stay on track. Um, like I said, my name's Matt. I was born and raised here in northern Utah. I've lived here in northern Utah, Logan, Utah, essentially my entire life. I served a 2-year mission for my church, and I was in Fort Lauderdale and Miami, Florida for 2 years. And other than that, just a quick trip here and there. So I'm a just a nice little country boy from the West. I am married and I have 3 incredible kids. My wife's name is Amberly, and I've got a 9-year-old and a 6-year-old and a 3-year-old, and they keep me on my toes. And they all know that next week starts tax season. My oldest son is already like, Dad, it's tax season, really? Like, how long till it's over? My kids recognize the swing in my work because I have an extremely busy January through April, and then the rest of the year I get a little extra time with my family, and they appreciate that. I have been a CPA for pretty close to 10 years. I've been working for the firm I'm at, CMP, for 11 years, and I did 3 internships before I joined while I was in college. So, been around taxes in general for 13, 14 years. And my other designation, I do have a CVA designation, which is basically an appraiser for businesses. Like appraiser for real estate, I'm an appraiser for a business where you can't necessarily, there's not a physical asset to turn around and sell a lot. So I spend about 95% of my time on taxes and 5% of my time on business valuations. So that's a little about me. Um, I'm just gonna jump into my format for how I plan to go through this. Is a couple of you submitted some questions, and I've kind of gone through and highlighted and numbered those, and I'm just gonna talk about those questions first. Then I had a few more things I thought would be important for this group, and then we were gonna kind of open it up for a few more general questions. Taxes is a very personal thing, and it's hard to get personal advice in a group environment like this. But the advice I can give in this group environment, while general, can I want it to just trigger in your minds like, hey, that kind of sounds like something I might need or possibly could apply to me, and I need to just to investigate that further. Whether you want to ask me specifically or whether you have your own CPA, you can just write down those ideas and know that, hey, there's something about this that might apply to me, and let's see if it does, and it'll help me. Um, okay. So one of the first questions is just said they need tips to be more streamlined in their accounting and taxes. Um, I heard the story many times of people who, it's the end of the year, it's February, I don't want to do it, but I'm gonna have to set aside 2 weeks and do my taxes. They're taking 2 weeks off of their job, 2 weeks off of making money to organize their receipts and add everything up, and they have to look at their personal cards and their business cards and just try and figure out where everything is. And that is very inefficient. And as a business owner, for you guys to have to stop your job for a period of time to go and do taxes doesn't benefit you. So yes, you want it to be as streamlined as possible. And I have um, a few tips on this in general. My first one would be have designated business accounts, a business bank account, a business credit card, and exclusively use it for business. I know it gets really hard when you're just running through and at the grocery store, and then you pull out the first card and it ends up being the business one. I know that can get hard in those times, but you'll save so much time when, well, what's my business? What do I have to go through? It's this one checking account and this one credit card, or these couple credit cards, you know. By having all the transactions in that be business, you're going to save a lot of time. It's not questioning Is it personal or business? And then what type of business expense is it? You know, it's all business. So you're just jumping to what type of expense is it? Because no one remembers 10 months ago their Amazon charge if it was personal or business. But if it's on your business card and you use it exclusively for business, you know it's business.
Hey Matt,
Um,
for those of them that are not like an LLC or an actual business and are a sole proprietor, it's okay just to get like a free checking account, right? Just
yep,
as long as they're separate.
correct.
Okay.
Yeah, you can still have another personal credit card, personal checking account, but as long as you designate that as a business account, everything that goes through there is going to be business. It doesn't matter that you don't have an EIN number and can get an account underneath your EIN number. As long as you have an account that you're using exclusively for business, will be your biggest help. Um, the second thing would really be going through your transactions monthly. The end of each month. If you're gonna do it yourself, you're gonna classify your transactions, go through it monthly. It's a lot easier to remember a transaction from 2 weeks ago and what it was versus a transaction from 6 months ago. Um, my wife and I joke about this every time at Christmas, just our personal Christmas shopping. The end of December, if I don't keep up on it, this transaction on November 14th, do you remember what it was? Because my wife likes to budget and make sure each kid's spent about the same, and we have to try and remember what it is, where it's a lot easier when we do that as it happens or just shortly thereafter. So going through your transactions monthly and being able to classify it um, will save time as well. Um, I see many different accountings when it comes to me for taxes. And what I mean by that is people who have listed out, here's my income and expenses, and they wrote it in a notebook and hand it to me, or they put it in Excel, or they use QuickBooks or Quicken or Wave. Um, but having one of those, having your own system, whether you use Excel or QuickBooks. I've seen a person who's extremely efficient. For him, he's got a notebook, and at the top of every page he writes something different on it. So first page is income, second page cost of goods sold, third page supplies, fourth page office expenses. And every time he spends something, he just writes it on the appropriate page, and at the end of the year he's able to subtotal it and have a total for each type of expense. And so at the end of the year, he just brings me his notebook. And while it's not electronic, it's not fancy, it's efficient for him. I can, if he hasn't subtotaled it, I can subtotal it really quick for him and go through it. But have your own system of accounting, do it monthly, keep your business transactions in one card, one bank account, one card. Um, those will be your biggest tips on being streamlined and efficient and getting your accounting to whoever you need, your CPA, your banker, your business partner. Those would be my main three tips right there. Um, the next question, just kind of asked like where do expenses go on a tax return? Um, three types of tax returns that you will be filing. The first would be a Schedule C, which is on your personal return. You're doing it under your social security number or you're a single member LLC. Um, very simple, just one page, two-page report. The other two are a 1065, which is a partnership, or an 1120S, which is an S corporation. Those are separate tax returns. Those returns can be anywhere from 8 to 9 pages to 25 pages for most people. Um, and so I'm not going to spend time telling you where items go um, because it's different for everybody. Um, all those forms have the main general accounts. They have about 20-25 main expense accounts that are listed. And then they all have another account which says other. So you can list if you want to list out your web hosting expenses and that's not one of those 25 categories, you can list those out separately. So I'm gonna leave that question there for now because it can be different depending on the form you're filing. So um, his next question was actually about 10 questions in one paragraph. So I'm breaking the questions up. just as we go. Um, First question is, what exactly can we write off? And the short answer to that is, if the purpose of purchasing, spending the money is to improve your business, to pick up work, to strengthen relationships with clients, um, I'm going to tell you it is most likely a write-off. Um, so if you're buying office supplies, you're buying shelving for your product, if you're taking a client out for dinner, um, business licenses, all those types of things are deductions. The main things that are not deductible are life or disability insurance is not deductible. Entertainment is not deductible. So taking a friend out to the golf course or going to a concert or a performance, while they can be strengthening a client relationship, are not a deduction under the current tax law. So if it can be construed as entertainment at all, that doesn't count as a deduction. Now, meals, so you take someone to a concert and at the concert you also purchase a meal for them. As long as that meal is on a separate receipt, it is a deduction. So um, just a couple things for there to keep in mind. But generally, if you're spending it to improve your client experience, it's going to um, help you in your business to grow. It is a necessary expense for your business. It's going to be a deduction.
So,
Um,
Matt, I'm going to jump in real quick just with Bomb Party specifics. So
yep.
that would include you guys as personal using giveaways. If you purchase a tablet or something for a giveaway, anything that you're using on your shows as a giveaway, as a prize or a promotion, we can run a ledger and keep track of our personal use. But anything
Hmm.
that you are personal using or buying for your business to gift to someone else, that's exactly what he's talking about your relationship with customers. So just keep that in mind. All those things. Also, any business supply, your label printer, your computer, your lights, any your crock pot. It could be anything that you're using to. I remember when I hired Matt, he said, Danielle, to keep it easy, he said, honestly, he'll touch on as far as space and utilities. But I remember him saying, Danielle, if you can show that your expenditure is helping you create money in your business, then I could fight for it. He said, but it can't be, well, the client and I were just trying to bond, so I took him on a roller coaster. I mean, it can't be something ridiculously stupid. It's got to be something you're spending this dollar here. And if you were to get audited down the road, can I fight for that and say, well, she used this to make money here? Right. So that's what he kind of helped me. So all right, Matt, I'm gonna
Okay.
mute myself because there's a question popping up in the chat. Can you see the chat
No,
questions?
I can see the chat. And
Okay.
what do you think, Danielle? Should I address them as they come, or should I circle back to them at the end? At the end? Okay. All right. Um, the next question, I think it's kind of two in one. It asks, do I need to have a business license, or is it okay to continue under my social security number? So there's two parts of that question. A business license typically is issued by your city, and it's an ability to do business in the city. So yes, you should have a business license. Now, the second part of that question, continue under my social security number. I think the question there is, do I need to have an EIN number, or can I use my social security number? And the answer to that is yes, you can use your social security number. Someone doing business that doesn't set up an entity is what's called a sole proprietor, and they use their social security number as their identifying number with the IRS and with the merchants that require identification numbers. Um, Depending on your state, setting up an LLC is a great alternative to having to distribute your social security number to who knows how many people. In Utah, where I'm at, the first year registration is about $60 for an LLC, and every year after that, it's only $25 to keep an LLC open, which I think would be well worth the cost of keeping my social security number more private. Now, there are other states. The worst one is California that has an $800 fee every year for the privilege of having an LLC in their state. And that's a pretty expensive fee. Um, if your main purpose is to keep your social security number private, that's a personal decision to you, what's it worth. Most states, I've seen most states, their renewal is somewhere between $100 and $300 a year on their LLC. Get you an EIN number, it gives you legal liability protection, something to consider. But if your business is small, it's hard to justify that. Yes, you can use your social security number, and be just fine. So, the next question is, should I be paying anything quarterly? So pretty common question, do I need to pay income tax quarterly? And the answer to that question is the point of it is the IRS, the federal government can't run with only getting money one time a year at the end of the year. So they're trying to get their money throughout the year, so that the government can run. So as part of that, they've made a law that, basically you need to pay money throughout the year so you don't have a huge deficit at the end of the year. And if you don't, there's what's an underpayment penalty, which depending on how much you owe, I mean, I've seen people who owe 30 grand and their fees $200. They might want to keep the money in their pocket longer and be able to utilize it, and then just know they have a big bill at the end of the year and have a small fee. I had one this year that before we adjusted, we're able to adjust a few things. He was estimated to owe total tax. It was like $800,000, and it was a $30,000 underpayment penalty. So there is a penalty if you don't pay enough throughout the year. Now, what's considered paying enough, or how do you pay in? This includes anything withheld on a W-2 if you're working. If you have a job that has a W-2, if you withhold on there, that counts as your withholding. If your spouse works, their withholding counts. And then anything you pay in quarterly. So if you don't have enough withheld on W-2s, or your only job is your business, then in general, yes, you should be paying some tax quarterly. And that tax is based off of your tax liability last year. If you pay in 100% of the tax you owed last year, and then you are exempt from the penalty, even if you owe tax at the end of the year. The other rule is if you pay in the tax on 90% of this year's income, you're also exempt from the penalty. So that requires you to keep up on your accounting and be estimating your tax throughout the year. Are two ways of doing that. But if you only pay, if you don't have a W-2 job, or every year you end up paying a lot of money at the end of the year, you're probably being hit with an underpayment penalty. And just a quick remedy for that is just pay a little bit throughout the year in each quarter.
So because this is gonna, you know, what I don't want you guys to do is absolutely freak out when we talk about taxes, because as a business, it's something in the US we just have to deal with. So with that said, like when you get to the point where, I can only speak in our experience, at our prior company when I hired Matt, I always did tax act or H&R block or TurboTax. I always took care of our own until I couldn't. When you start making money higher than you have, or you don't know how to control it at that point, that's when you hire someone that does. So that's how we ended up. We actually made a bad accountant hire. Give you just a quick little story on how I found Matt. Hired as an accountant that was recommended, and they weren't doing a great job. And I was really afraid that we were probably going to get an audit. And someone told me about Matt. So I went to give notice to the other person, and they took admin rights of my QuickBooks. And I had to fight QuickBooks to prove that I owned my business. So if you just go hire just some random accountant somewhere just to do your taxes, please make sure that, one, they know direct sales, which Matt's firm, they know direct sales very well. They have bookkeepers and things like that too, to where if you do get to the point, like I tell my team, when you get to the point where you hit Ruby in this company, you should look at making yourself an LLC, which that's the first step of their leadership, Matt. You should
Right.
look into making an LLC and possibly look into accountants at that point because you're going to be making a different level. You're going to start making a different level of money. If you're a top seller with the company, on top of that, you need to make sure that you're protecting yourself too. So I know when Matt took my books, he had to literally go over the last person's work and make sure that if I were to get audited, that he was comfortable answering for that accounting. So don't freak out completely, be like, oh my God, I've never paid taxes. What am I going to do? It's nothing like that, you guys. I mean, they don't be afraid like that. I think, I'm the queen of not knowing what I'm doing. That's why I hired him. So I think when I came to Matt, he's like, so you've been paying taxes quarterly? And I'm like, no, but I've been putting 25% in the savings account. And he's like, okay, well, how much you got in there? And we ended up okay, but I didn't know. I didn't know either. So, all
Uh,
right, Matt, sorry about
yeah.
that, but
Yep. Nope. You're just fine. The next question is, should I have been keeping track of my giveaways, whether it be the prizes won or reward cards given away? So giveaways that you are purchasing, if you spend money on it to turn around and give away, is a deduction for your business. Now, if you are winning something that you are getting for free and then turning around and giving it away as a giveaway, because you didn't spend any money on that, the IRS doesn't consider it a deduction. The IRS wants to know how much did you spend on it, and that's when it comes to deductions, there's very few deductions that are show me the transaction in your bank account where you spent money on it. Um, so if you are receiving an award and then turning around and giving it away just as a way to promote business, that doesn't need to be tracked. But if you're spending money on something and turn around and give it away, it should be in your advertising or your gift account, which I typically add into my advertising. That's what you're doing, is advertising your business. So yes, keep track of the ones you spend money on. Um, this question, do I need to have taxes done separate from my personal, or does it get combined? So I mentioned earlier, there's a couple different types of forms. A Schedule C is the business form that is on your personal return. So everything is on one tax return that gets submitted to the IRS. This is typically, you'd only be a Schedule C if just you're really in this part-time, you're not making a super large amount of money, it's kind of a side gig. One of the main reasons is because all of your income on a Schedule C, so total income minus total expenses, your net profit after that, that net profit is subject to self-employment tax, which is both the employer and employee portion of Social Security and Medicare. So it totals 15.3%. So if you make $10,000, that's $1,500 in self-employment tax on top of income tax you have to pay. You make $20,000, now you're at $3,000 of self-employment tax. You make $30,000, you're at $4,500 of self-employment tax. That can add up really quick. So I typically tell my clients, if you're between $20,000 and $30,000 of net profit, you may want to consider a different entity structure to save on self-employment tax. Doesn't necessarily mean that you're going to change, because it might depend on your situation and what you want to do. But up until that point, if it's just for tax savings, the cost it's going to take to file another tax return and any other required reports is going to be greater than the benefit you receive in savings. So keep that. I would say that's one of the things to just keep in mind. At $20,000 to $30,000, I need to talk to a CPA and see if I'm still in the best situation filing a Schedule C. If you're making more than that, then you're either filing a partnership or an S corporation. Both of those have mechanisms within them that help save on self-employment tax. There is not a deduction that you can take on on a partnership or an S corporation that you can't take on your Schedule C. So your income tax is going to be the same whichever way you file. The main thing we're doing is controlling self-employment tax. So the answer to that question, should I have done taxes separate from my personal, or can they be combined? Like I said, taxes are very personal, depends on your situation. They can be done either way. We have some professionals in town that make $1 million on a Schedule C, and they're comfortable with that. We've got other professionals that make 20 grand and they want to be an S corporation for insurance reasons or for bank reasons, and so it really depends on your situation. But in general, just to cover that, they can be done either way. You're not getting by not you're not getting a better benefit for income tax purposes by being one of those entities over another. Next question is, when asked about my annual income, how do I determine that answer? That is part of the reason I say it's good to keep track of your accounting monthly, to go over your bank statements and credit card statements monthly, because business owners' income can go like this. And it depends on the year, depends on the month, can be a very cyclical nature to your business. And so if the banker says, well, what was your income last year? You can pull up your tax return. But if what's your income this year, you have to catch up your accounting to be able to tell them, because it could be night and day different from last year, just depending on how stable your business is. It's
That,
a good,
can I
yeah,
jump in real quick here?
you bet.
So you guys, basically, when he's talking about an S corp or things like that, he's talking about an LLC for those of you that are kind of
Mhm.
trying to navigate that. But there's certain protections and obviously, advantages to that. But when he's talking about keeping track of your expenses and knowing basically your net each month, you can use QuickBooks or Quick Enter or thing like that to help you along. If this is not your strength, my rule of thumb is my time is money and so is yours. And if I'm not a professional and an expert at it, I am going to hire someone if I can afford to do that. If it's costing me less than $10 an hour, I can hire someone. But in this case, bookkeeping is not my jam. I know I am not a bookkeeper. And I think I paid, and I will budget this before I'll do anything else because I'm not keeping these books. But we have several businesses. So if you're getting to the point where you're doing really well, and he kind of threw out some figures there, even look into bookkeeping. It's not, you can find bookkeepers to keep your books. Just make sure it's someone that is credible, that is not going to get you in trouble. But it can be anywhere from like 200 to 400 a month, depending if they're with a firm. I think we pay right around 450, but they do our payroll and our bookkeeping and everything. So for me, the peace of mind is big. I can go into my
Uh-huh.
QuickBooks and I know where my business is sitting. So, and I certainly don't know what I'm doing. Y'all
And
know.
and for a lot of people, I mean, Danielle, I think our bookkeeper spends anywhere between 2 and 5 hours a month on your bookkeeping every month. If you had to do that, how long would that take you?
I
We like
muted
to think
myself
we're at least
already, but
twice as
like you
efficient as,
guys, it would not be a pretty picture. I would not be selling jewelry and I would not be leading my team because I would be Googling trying to figure out what I was doing. Because
yeah,
truthfully, I don't know.
yeah.
So,
We like to believe that because we're in it every day, we're several times more efficient than the average business
mhm,
owner. And so I would say, Danielle, we should be saving you at least 2 days of your time. And
yeah.
how
Well,
much
and
can you sell in 2 days of your time?
I
Like
kind of
it's just
want,
the opportunity for you.
I want them to see things in a bigger picture because a lot of you guys, and this is just in general as business owners or as humans, we see things as we are sitting right now. So if you are keeping your business the way you're keeping your business now, and you go to look at your income and you're making $500,000, what are you going to do? Because that's a possibility. What if you're making $100,000 a year? Is what you're doing now going to work? So I had to have that come to Jesus with myself is I am continuing to grow in my sales and grow in my other businesses and growing in my team. Can I manage this beast? And it was certainly no. You can do tax act for a while, but when you start making a quarter of $1 million a year, just me bringing that in, we've never seen money like that. So it's time to get a professional. So think bigger. Think of where you're going. Don't just think of where you're sitting today. And that's why I'm bringing you guys, Matt. As you grow, you need to just have your your stepping stones to where like, okay, I'm uncomfortable now. This is above my head. Now I might need to go look for somebody, right? So sorry, Matt. All right, that's all
Nope,
I got.
nope, you're just fine. You're just fine. Um, let's see. My last question on this one is, can I kind of claim my home office as an expense along with a portion of my utilities, cell, and vehicles? So those are some of the most common expenses, so I will go over them. The home office expense, there's two ways the IRS will let you calculate this. The first one is what the IRS has is the safe harbor method. The IRS will give you $5 per square foot up to 300 square feet. So the max deduction you can get for your use of your home is $1,500 a year. Now that covers the cost of your share of interest, of rent or mortgage or repairs, utilities, except internet and telephone. Those two are different. So it's either you can take a lot of those expenses or you can take the safe harbor method. So the other method is actual expense method. Actual expense method, you measure the square footage of your office and you get your square footage of your home and divide the two to get a percentage. So my home office is 7% of my house, total house space. So then you can multiply that 7% by all your common expenses. So mortgage interest, property tax, insurance, utilities, general repairs, any of those other expenses. I mean, depending on your home office, you might even be able to get yard care and snow removal on there, Um, so the actual expense method will usually give you a higher deduction, but if you are ever audited and you claim the home office deduction, the IRS will audit that. That is a one that is not ever held to the standard the IRS considers home office. And I'll tell you a story about that. I heard this at CPE at my continuing professional education 6 or 7 years ago, but a CPA had a home office. And one of that CPA's clients was being audited, and the auditor called the CPA and said, "Well, we need to meet so we can go over this. Where would you like to meet?" And they determined they'd meet at the CPA's office. And the CPA was like, "Sweet, they won't be at my clients, they won't be harassing them. We'll just be able to get in, get out, get this done." So the auditor shows up to the lady's house, the CPA's house, and the CPA lets her into her office. They have their meeting. During the meeting, the CPA's husband tries to come in with his coffee to watch TV on the couch and turns around, tries to come in a couple times thinking she's left and doesn't. In the corner, there's a little desk set up with some coloring projects and some little aids for their kids at school. There's a big basket in the corner where their cat sits. Um, well, the auditor gets up, finishes, and says, "You know what? I believe you're right on your client. I think you've defended this, so I think you're good. But I'm going back to the office and I'm going to pull your tax return and see if you claim the home office deduction because this is not a home office. And if you did, I'm going to disallow it and we're going to open up an audit into you." If you have a home office, it is a home office. You don't have anything there. I mean, they're stricter on this than your personals than my office here at a building, not at my house. I've got kids' artware over here. my kids come in occasionally and see me, my wife comes, but the things that disqualified their office, their husband was used to sitting there and watching TV. You wouldn't let your spouse come to your office and in their pajamas and watch TV with their coffee. Um, the IRS thinks that you wouldn't bring an animal to your actual office, so your animal's not allowed in your home office. You certainly wouldn't have spaces where your kids are going to be set up because you need to meet with your clients, and you can't do that with your kids in the corner, asking you about their homework. So the actual expense method, we actually steer most of our clients away from it because if you have a home office, your kids are going to come in. Your dog's going to be there. Your spouse is going to be there. You're going to accidentally store something personal there. You're going to use the business computer for a personal search occasionally. But all those things could disqualify your business use of home deduction. If you use the safe harbor method, the only thing the IRS is allowed to challenge is your ability to measure square footage. Um, so we can guarantee you up to $1,500 on your tax return, and you're pretty bulletproof. Or we can take the actual expense method and you could be doing it right 99% of the time and have 1% you're not. And if somehow you were caught, you could lose it. So that's kind of a comfort of the taxpayer question. Um, we'll let our clients take it, but we just explain that to them just so you know, here's a list of things that can disqualify your office deduction. Here's your deduction. IRS probably won't audit this for 3 years. So in year three, when they overturn it, you'd have to pay 3 years of interest and penalties after you pay the tax back. So a big thing on that home office, like I said, it covers utilities except internet and telephone. Um, internet and telephone are ordinary business deductions, and you can take them. They're not considered part of utilities. Now, if you're sharing that utility in your home, then if you're sharing that utility in your home, yes, you should break it out as this is percent is business, this percent is personal, and only take the business percentage of your cell phone, of your telephone, of your internet. You can do that. And then vehicles. The IRS, you're allowed to deduct vehicles as a business expense, as long as you're using it for a business purpose. This is a spot where people get extremely aggressive. I'm sure all of you know of somebody who's put a small sticker on their back windshield and claim they're advertising for their business 24/7, and so they write off the whole vehicle. That is a common attitude of business owners, and we'll let them do it, but we tell them the risk. Um, there's two methods of vehicles, deducting vehicles, and I'll kind of talk about the two methods and then just why you would choose one over the other, and kind of what would be required in defending an audit. Like the business use of home off method, there is a simplified method for claiming a vehicle expense, and it's the miles method. Every year, the IRS publishes a mileage rate that you can use for a business deduction. For this coming year, at 65.5 cents a mile. For 2023, at 65.5 cents a mile. So what you'd be required to do is keep a mileage log. On this day, I traveled to this location for this business purpose, and here were the miles I traveled. That is what the IRS requires on using the miles method. End of the year, you sum up your total business miles, multiply it by the the miles rate, and that is your automobile deduction. That covers the cost of your vehicle, gas, insurance, registration and licensing, repairs. It covers basically anything you do to your car, you don't deduct, and you take this miles method instead. The other method is actual expense method. So you take the cost of your vehicle and you put it on a depreciation schedule and depreciate your vehicle over 5 years, which means every year you take in theory, a fifth of the cost of your business as a deduction. You track gas, receipts, repairs, licensing, insurance, and you deduct all those expenses. Um, the actual expenses, and that's your automobile deduction for that year. Now, the IRS, in general, if your vehicle is used both personal and for business, doesn't allow you to take the actual expense method. Um, they certainly encourage the miles method at that point. If you want to do the actual expense method, you need to come down and you need to break out this is the amount I use personal, this is the amount I use business schedule, and put it, um, have that, have some justification behind your percentage. So I use it 60% personal, 40% business. For these 3 months, I tracked all of my uses, and this is how I came up with this breakdown of what was business and what was personal. And then you would take your business expense of your that business percentage you would take of all of your expenses. Now, in general, if you're using a vehicle 95% for business, the IRS, you'd be safe to claim 100% of that vehicle as a business vehicle. But if you only have one vehicle and it's used pretty mixed personal and business, the IRS encourages the miles method. Um, you probably would get a bigger deduction using actual expenses, but you have to, yeah, like I said, come up with a method for determining what percentage is business and what is personal, and keep that as your proof. And then show that, hey, here's my total gas expenses, and then my business percent is this, so that's my gas expense. Um, like I said, this is a very common one that just business owners, it's a common one to write off a vehicle anyway. So, um, happens a lot. It is possible. IRS audits less than 1% of returns. So as long as we keep things reasonable, that doesn't cause red flags, the IRS isn't going to check your return. In general, that's another thing I'll just say, reasonable expenses. Um, as long as your expenses appear reasonable at a high level glance over, the IRS doesn't really challenge those. They challenge the ones that like that is obviously wrong, so I'm going to go look at that one. But as long as expenses are reasonable, then they're not going to double check. They're not going to dig into that. So one example of that is beauty expenses. In your guys' profession and some of the other groups I've been in, it's important that they have a very good appearance as they do their presentation. So a lot of the ladies will get their hair done, and they'll get their eyelashes done, and they'll get their nails done and get special jewelry and a new suit. And the IRS challenges a bunch of those expenses and says they're personal. Like, you get your hair done every 2 weeks anyway, so why is this a business expense instead of a personal expense? Um, so one thing you can do to kind of counteract that is just make sure your expenses are reasonable. So in the case of beauty expenses, if you have $10,000 of income for the year and $200 of beauty expenses, that's pretty reasonable. But if you have $10,000 of income and $5,000 of beauty expenses, the IRS would challenge that. They'd say you're just writing off your personal life, things that you like to do, things you want to wear, and trying to write it off through your business. Um, so reasonable expenses do favor those higher earners because it's a lot easier to have a more reasonable expense when you have more income. This is something I do look at on my clients at the end of the year. I have a couple expenses, beauty expenses, the biggest one that just at the end of the day, after I've done their return, I can see total income, net income, and I circle back to this. Is this expense going to be reasonable to the IRS? If not, I'll talk to the client and say, I think we should claim less of this year, and it'll be less of a risk. Um, so I will do that. what I just really wanted to reiterate is as long as your expense is not drastic and it is reasonable, you haven't given the IRS a reason to dig into your return. And they don't go after, there's something there, they go after like there that's something's obviously wrong, and we can probably get significant money out of this guy by auditing this. So
Yeah,
reasonableness.
one thing, because I know, especially on my team, there's multiple people that have come over from other businesses that have liquidated their prior companies. Can you just basically touch on that where, if they did liquidate, like, well, I'm gonna kind of, and you correct me if I'm incorrect. How's that?
Okay.
So when I was moving over businesses, you guys, one thing that he said when I said, well, if I were to go and donate some of this product to an actual charity and get a receipt and keep, I had a tracking sheet of exactly per piece. And he said, you must be able to prove in an audit that you paid for it. And you can only get the price point that you paid for it. So not a retail. And so in our case, we ended up picking three charities and splitting it between those three, notating exactly what we gave away. But we put that, if I'm correct, under advertising as a
Yeah.
donation, correct?
Yep. Yep. Because you didn't turn around and sell it, but it was inventory you had. My experience is I'm going to tuck it into advertising, because when you donate to a charity as a business owner, part of it is to get your name somewhere, right? That's the big deal point of it. So I tuck it into advertising for that reason. But yes, if you're liquidating inventory from a prior business, even in your current business, you get to the point where, hey, I've had this thing for 3 or 4 years, it's time to liquidate. You can give it away. You can give it to a charity. Um, you can give it to a charity and get the deduction for the amount you paid for it. You did hit the nail on the head there, Danielle. It's just the cost. The only deduction is the cost you get, your cost to it. Um, there are very few things where you you would get higher than what you actually paid for it, and that's general rule is what you paid is your deduction. So, yeah, if you paid $10 for that product and you gave it to a charity, then $10 is your deduction. So,
I think a lot of people are just so confused, especially if they're newer business owners. When you say something like donate it, they automatically think on their personal taxes, sending something, a bag of clothes to Goodwill, and a donation
mhm,
there. This is separate, you guys. This is on your business side. This is not on
correct.
your personal side. So if you gave dishes to Goodwill, that's a personal donation. This is going to be on your business side, offsetting your income from your business, right?
Mhm.
Am I correct?
Yep.
Okay.
Yep. And the reason you want to make sure you put it on your personal return, or sorry, on your business return. If you're a sole proprietor filing on a Schedule C, you're offsetting your income that's subject to self-employment tax by that donation. Whereas if you don't take it on your business return and you take it on your personal return, you're gonna pay self-employment tax on a higher amount, even though your income tax will be a little less. Um, so it is a business. It was part of your business. It's a business deduction. One thing to remember is you can only deduct something once. So a common thing that we actually have to correct some business owners on is you buy a computer and you expense it. You took a business deduction for it, and then 2 years later you give that away. Well, your basis in that equipment, that computer, is actually zero because you expensed it. Um, so there is no deduction for that. But if it's your inventory that you're holding on your balance sheet, you're waiting to expense it until you sell it, then you have some basis in that and can sell it. Um, Same thing if you say you purchase a car and it's on a 5-year depreciation schedule, and in year three you decide to donate it. Well, there is a deduction there, but you've depreciated about 60% of that vehicle. So only about 40% of your vehicle is going to be actual count as a deduction or as a contribution for you for that year. That's something you'd need a depreciation schedule for. If you're using a CPA, you need to talk with them, tell them the date you donated, and you can calculate depreciation and let you know. But yeah, you're only allowed to deduct something once. And if we can put it as a business contribution, it does help out business owners. Um, that was all the questions. I just wanted to touch base on a couple other things I felt were important, and then we can circle back to some questions. Um, we've already hit on entities a couple times. There's three main types of entities: sole proprietorship, partnership, and an S corp. Now, LLC, everybody knows the name LLC. An LLC can be taxed as a sole proprietorship, a partnership, or an S corporation. Um, it's just more protections are provided to an LLC than a general partnership or sole proprietorship. And for flexibility, the government allows it to be taxed as an S corporation. I generally tell people starting out, if you feel like this is going to be good, if you're going to make money off it, you're trying to make it your career, start off with an LLC tax as a sole proprietor. So you're filing on a personal return. It's not costing you extra to file an extra tax return. Then as your business grows, it's really easy to change an LLC tax as a sole proprietorship to an LLC tax as a partnership. And then if your business grows even more, we can switch it really easy to be taxed as an S corporation. And that gives you a lot of control once you're taxed as an S corporation. It's really hard to go backwards. It's really hard to go from an LLC tax as an S corp to an LLC tax as a partnership. An LLC tax as a partnership to a sole proprietorship, not quite so hard, but to switch from an S corp back is hard. So I tell most of my clients, when you're starting and it's going to be good, start small, start as the sole proprietor, and then work your way up as it makes sense. Um, I do have one lady I've helped in a different um, direct sales business that was insistent that we set her up as an S corporation, which gives her a lot of control. But in her situation where she was having net income of $1,000 to $3,000 a year, it was costing her extra money for me to file her tax return and her quarterly reports than she was saving. And I tried to explain that to her, but she wanted the control that can come with an S corporation. And now she is in a bind, and it kind of hurts to pay my fees. And um, it hurts me because I tried to help her and she wouldn't listen. Um, so start small, grow with your business. If you have a reason why you feel like a different entity would be different, call me and chat over with it. I'll chat over that with anybody, let them know what I think would be best, what would provide them the best situation for them. So
That's one thing I wanted to say. We actually interviewed Matt. So I told you, we made a bad hire, you guys, with an accountant prior to going with Matt. And yes, he did over 100 people in my prior company, and I know he was well respected, but I was terrified. I just bought QuickBooks trying to get all of our stuff back. So just know that you can call and set up a time and find out, if you feel like, he's really an honest guy to where he'll say, I really don't think you need me yet. But when you get to this point, 100% you're going to need to start. So that's one thing that I appreciate is Matt's never pushed us to what's the best way to put this? Like
I'm
purchase
not
extra.
trying to build my bill by
Yeah, like
making you do something
yeah,
different.
you need to do all these things. He would say, no, I just really don't think you're there yet, Danielle. Once you get here, here's your next step. You really need to think about doing this. And after 4 years, trust me, we've been in good shape. So I wouldn't have
Yeah.
brought a training, to this company had I not had that full trust. So,
Yeah.
all
Well, I
right.
grew up in a very humble home.
Oop, I unmuted you.
There
Sorry, I
we go.
muted you. We
Yeah.
switched spots.
Just saying, I grew up in a very humble home, and I know what it's like to feel the pain of paying extra and then find out you paid for something you didn't need. Um, I remember one experience going to the dentist. I'm one of 8 children. I remember going to the dentist with several of my brothers and sisters, and then coming home, and then a week later, my mom got the bill, and The dentist had done a couple things that she had asked them not to, and it hurt. It hurt our family. And I see that as the biggest disservice I could do for one of my clients is to push them into a situation where I get to bill them more, but it doesn't benefit them at all or hurts them. Um, so like Danielle said, I try not to be pushy. I try and do what's best for each individual, um, for your business to grow, and to feel comfortable with me. With each of my clients, I try and build a relationship of trust. I get clients that come back to me or refer me because I do a good job. If I'm doing a terrible job, I'm not going to grow at all. So, um, thanks for the little plug, Danielle. I appreciate it.
Well, and it's not for me, it's not even a plug. Like I can go to sleep at night and know I'm not going to I have a CPA as a father, you guys. I grew up seeing people get destroyed by the IRS, and I'm scared to death of them. So when you've seen that your whole life, and if someone does get audited, which is very rare, but he did very high caliber clients, so it would happen. And that's scary. I mean, he would get, they would get out of the audit, but watching that whole thing happen, I am not comfortable with just putting my stuff in someone's hands and saying, "Oh, good luck,"
Run with it.
And sometimes, like my first hire, she was very well, you know, everyone said, "Yeah, go with her," and not okay. Yeah, Lisa Keller's on my team. She came from another company, a very top seller, and she uses you guys too, Lisa Keller. But there was something really important I was going to say, and I forgot. So when I remember, I'll unmute. I'm
You're
ADD, so
good.
if I don't
You're
remember at
good.
that point. All right, go ahead.
Next thing I was going to talk about was inventory and cost of goods sold. You guys are in a retail business and direct sale business. Um, your deduction when you buy product to sell, that deduction happens when you sell the product. The IRS, when you're in a retail business, asks you to match up expenses with sales. So an obvious example of this is a car salesman. Let's have a car salesman who sells one car a year. So year one, he purchases a car for $50,000 and he's going to sell it for $100,000. If he does it right in year one, he has no income, no deduction. In year two, he sells that car for $100,000, takes his $50,000 deduction, and he has $50,000 of income that he can expense, or $50,000 of income that he reports that year. So then he turns around and buys another car for $50,000. That's in year two, but he doesn't sell it till year three. He still reports $50,000 of income in year one, and he has $50,000 of income on $50,000 vehicle on his balance sheet for when he sells that next car. So if he had done it wrong in year one, he purchases a car for $50,000 and deducts it. Well, under current law, your new business losses are limited to 80%. That was all of his income, so nothing gets deducted. In year two, he sells that car for $100,000. He sells, so he sells it for $100,000. He purchased car two, so he writes off $50,000, and then he writes off 80% of his loss from the prior year, so he writes off $40,000 of income. So he has $10,000 of income that he pays tax on in year two. Then in year three, he sells car two and he doesn't buy another car. Well, in year three, he has $100,000 of income. And he's going to pay more tax on $100,000 of income than if he'd reported it right and reported $50,000 of income in 2 different years. So that's an obvious example. Bring it back to our bath bombs, our jewelry, our small item retail that we're doing. There's people who do it wrong in December, purchase a lot of inventory. Let's purchase a lot of inventory so we don't have to pay taxes. If you do it right, all that stuff you purchased in December should be sitting on your balance sheet. It's not taken as a deduction in the year you purchased it because you haven't sold your product yet. So you spent down all your cash to buy product, and now you don't have money to pay your tax bill the next year. Um, so I've seen this in the other business Danielle came from. A lot of people would buy tons of inventory at the end of the year, thinking they're getting this write off, and they would do that 2 or 3 years in a row. And then they're wondering why they have $50,000 of inventory in their garage and why they're still paying taxes. And you try and explain that to them again, and it's just you just the main thing to remember is you get your deduction when you sell the product. So the strategy of buying tons of inventory is not a good tax deduction, not a good tax advice.
Luckily, with this company, it's so much different where we have new styles or new styles, even of our originals, our sterling and all that that come out every single month. So it wouldn't be the wisest decision to go buy thousands of an original collection because you get the new styles coming out the next month and now you're sitting on old styles. So I can tell you that you can't promote buying incentives here. You can't give back office credit so people can go buy. So there's a lot. This company really helps you not go into debt, which is very
Good.
appreciated over here. So yeah, I don't think that there may be few and far between that will run into that problem that you're talking to. I think that that's good, solid advice that they all need to hear. Like, don't go and stockpile. But
Yeah.
for us, it would be no benefit to do it anyway because you're going to be sitting on old collections and old jewelry. So,
Okay. Good. Good. I should have talked with you earlier about that, but yeah, just the main thing to remember, expense it when you sell it, don't stockpile. Um, and then the final tip I wanted to give to business owners is your biggest liability protection. Um, your biggest liability protection from lawsuits. Now, I'm not a lawyer, but this is what lawyers say. Um, this is your biggest liability protection from IRS as well, from intermingling your personal and your business life. From a tax perspective, the worst thing that can happen to you is intermingle your business and your personal life to the point that um, if you are sued by IRS, by state, by somebody else, that they can come after your personal car, after your personal house, after your personal bank account to satisfy their lawsuit. So your biggest liability protection, I've already mentioned the first one, is an entity. That's why if this is something I'm going to do long term, I'm doing all right. A single member LLC, if your state is not super expensive, um, it would be what I would do. Having an entity set up with an EIN number gives you a lot of protection.
with a couple, like, our situation, my husband
Mm-hmm.
and I both are 50-50 owners of the LLC. Um, if you guys are 50-50 owners of an LLC with your spouse, I would suggest that you email compliance, as have I, and basically ask them to put my business, my consultantship under my LLC name. For a couple reasons. Obviously, if I were to die tomorrow, our LLC is the consultant and Jason can continue. So, Matt won't be able to answer things like that, but if you are a 50-50 owner, which would be what, a joint LLC? Would that be considered a
Be an
joint
LLC
LLC?
taxed as a partnership.
Okay.
Yep.
So if that is you, whether it's with your spouse, your daughter, your aunt, your uncle, whoever it is, it's more than just you. I would send an email just for clarification of how your business needs to read with the company, versus like we want ours obviously in the LLC name. So,
Yep.
all right. Sorry. I
Okay.
know that there's some questions about that kind of thing in the chat. So I know we'll talk
Okay.
about that more.
All right. So first one, having the entity. Second one, we've talked about already too, having a business bank account and a business checking credit card. Um, if you set up an LLC, your EIN number, set up your bank account under that name and EIN number. So they're fully designated as business. And then the last thing is what's called separate accounting, which is you keep your personal life on your personal cards, your business life on your business cards. If you can do those three things, you've set created a really good barrier between your personal life and your business life, so that the point of a lawsuit, most people, the most someone can get is what's in your business checking account and your inventory. Um, so like I said, I'm not a lawyer. If you're worried about liability, legal liability risk, you should talk with a lawyer and double check and see what best fits you. These are the things that most lawyers talk about. And from tax perspective, we also talk about keeping your business protected um, as your biggest liability protections there. That is all I wrote down as well. So I'm gonna come down here to the chat unless Danielle, you want to go over something
No,
first.
no, that I was gonna ask if you just wanted to go to the chat for the questions. And guys, if you wanna drop your questions in the chat, we'll do just a couple of those. I don't want to keep Matt forever just because I know he's busy.
It's
And I
coming up,
appreciate it
busy
so much.
time. All right.
Go ahead.
Let's see. Lisa asked, can we use time and space for utilities? So as a business owner, your time doesn't count as a deduction. Now, if you're an LLC tax as an S corporation, you're paying yourself a wage. That wage counts as a business deduction, but then you turn around and pick it up as a W-2 on your personal return. Um, but in general, the IRS does not allow a deduction for your time. So I'm trying to think of an obvious example of that, but I mean, can't think of one right now. But yeah, your personal time, there's because you're not spending any money that's going to somebody else, the IRS doesn't allow deduction for it. We talked about utilities with the business use of home. Is it true that time space is an audit flag? Um, if I mean, depending on your description of an expense, if you write, personal time as an expense, yes, that would be something that it was flag. That would be an audit flag. If someone looked at your return, that'd be an easy one to say, let's check into this. Um, Time. All right. I think we got that one. If I need to clarify on that, if I need to clear anything on that, Lisa, let me know. Angela uses the safe harbor. Lisa, I dissolved an S corp a few years ago. I have an issue now getting an EIN through the IRS. Any suggestions? If you're trying to get a new EIN number using the same name, and your same information, if you dissolve an S corporation, the IRS doesn't let you reuse that for 5 years. So that's why part of, if you become an S corporation, going back to a partnership, you have to dissolve your S corporation. And the IRS makes a rule that you can't become an S corporation again for 5 years. Now, if you're a different business and you're going to use a different name, it should be pretty easy to get a new EIN number. You just have to use a different name. It is tied to your social, so that's why the name makes a difference. Use a different name. I haven't run into a situation yet where I haven't been able to get a new EIN from the IRS. Um, so might have to chat a little more personally on that one, Lisa. But if you get an EIN number, you can usually get it in 10 minutes on the IRS website for anybody who needs it. Let's see. Sadie asked, how does it work if we have an LLC with two people, husband, wife? So if you're husband, wife, joint owners, then law is two people in business together are a partnership. Now, if you're an LLC, you're an LLC taxed as a partnership. So you should be filing a second return. Because you're husband and wife, some tax practitioners will put it on a personal return, as if one of you owned it. Now, one thing that you could do is if you have your family trust own the LLC, but you two are working in it, then yes, there's only one owner, the family trust, so it is done right on a 1040. But if it's husband and wife joint owners, that you should be filing a partnership tax return, a 1065 is the form number. Let's see. Your advice is Ruby and above for a CPA. Danielle, what level is Ruby? Is that done by sales or net income?
So it's actually both. With this company, what's really nice with their ranking system is you can bring 50% yourself as far as volume and the remaining. So Ruby is your career title. So that's not sales, that is team building.
Okay,
Um, Here you can, with this company, you can bring 50% of that volume yourself. And then your team can bring the other 50, which is kind of nice. But when you get to that level, I think there's three stages of their comp plan. And Ruby is like their first level of leadership per se, but it's
okay,
at the tail end of their second tier. So, by then you're probably making anywhere between 4,000 and 7,000 a month.
in your
I would
commissions?
say, yeah, I would say you need to, and then you're selling on top of that, you need to probably
Yeah.
be looking into that.
Yeah, at that level, I would agree with you. If you're making 4 to 7 grand a month on commissions, you should probably consider um, upgrading your entity type to save on some tax there. Um, Thanks, Lisa. I appreciate recommending me, complimenting me. I'm grateful for the privilege of working with you too. Um, Suki, I have an EIN with my daughter, but not an LLC. Would that still be a partnership? So yeah, two people in business together is a partnership. So if you have an EIN number for your business, then that EIN number should be associated with a business tax return. Now, you could have got that and started as a sole proprietor, and then you added your daughter, and that made it a partnership. Um, so yeah, in general, two people working together is a partnership. Um,
I just
all
read through it.
right.
I just read through the rest of them. It looks like majority of them just said thank you. One said that
Okay.
you already answered it. The one that said she said it's almost been 5 years, different business name, but
New
same.
business name. Hmm. Lisa, I would, um,
Maybe message Matt and he can talk to
yeah,
you on the side.
yeah,
So
I would want to
I
try online and see if I can figure out if the IRS has a message that comes back and says why they wouldn't allow it. But yeah, I haven't had an experience yet where I haven't been able to get an EIN number online in 15 minutes or less. So maybe if you want, we can chat and work on and see if we can figure that out. Um, for everybody, like I said, I'm willing to chat with everybody. Our firm does a free 30-minute consultation. Um, I enjoy helping people. And so I'm not gonna turn you down if you're planning to use someone else, but just needed some advice. My information, if you want to contact me, my phone number is 435-750-5566. Um, that'll get you to my firm, and then you just ask one of our administrative assistants for me, and they'd get you to me as long as I'm not in an appointment.
I did put your, just so you know, I did put your email, your website, and I believe the phone number in the actual confirmation that went back to them when they registered.
Okay.
So they
Actually, I should
should
have got
all
that. Just
have
let
it.
me.
There's one more question that came across for you, and then
Okay.
we'll unchain you, okay?
Let's see. I didn't see it in my confirmation, so so everyone has my email as well. Sorry, maybe I'm not reading it right. It's kind of hard to read fast while you're on a presenting. Can you hear me now, Danielle? No? Can anybody?
Okay,
All
I
right.
can hear you
Okay,
now.
there we go. And my email address, just in case anyone's missed it, is mjensen, Jensen, at cmp.cpa. So Let's see. One last question from Sandra. I'm married and have an LLC and have a couple different businesses, but I run them all on my own. Is that a partnership? If you are running it all on your own, your husband, your spouse hasn't invested or isn't contributing time to it, then you can be a sole proprietorship. Now that runs into some issues. Some states are what are called community property states, and what one spouse owns, they both own equally from the date of their marriage on. And if you live in one of those states, even if you it's unless you're able to specify in your beginning documents, then yeah, you would technically be a partnership. Now, the IRS isn't going to ding you for that if you're filing as a 1040 on a Schedule C, a sole proprietorship. But if you're on your own, then yeah, it is a sole proprietorship. If you have a spouse, and depending on your income, you might want them to be on your return to save on some self-employment tax. Um, Seems like I
Me,
had one last thought, but it disappeared.
you guys, in this, I mean, your situations too, but if you have multiple businesses and you're under your LLC, you need to also think about you're not invincible. And if you die and it's not a 50-50 or a whatever partnership with your spouse, it won't necessarily live on. When you die, it dies with you, correct, Matt? Yeah.
Yeah. I mean, the hardest part about that is, if you're the 100% owner, then you're the only one that has access to everything. And if you pass away, um, for your spouse to get access to whatever they possibly can of your business is going to have to go through the court system,
Mhm.
which would be attorney fees, and anything that goes through the courts is by default public. So
Right.
anybody could go through the court documents and see, oh, look, they're trying to get access to a bank account with 50 grand, or like,
Well,
so,
in your
so
business, I mean, in most direct sales companies, if you're not an LLC or a partnership like that, and one does pass away, the consultantship is gone. Where if one passes away and it's still a 50-50 ownership, the LLC is the consultant, then it doesn't die with you. And that was my biggest thing is if one of us were to go, I have with where I came from and then happening here pretty quickly, if you have a pretty large team, you need to have someone still taking care of that team. So, I would just
yeah.
keep those kind of things in mind. And again, start thinking bigger than where you sit today,
I,
and just know what your next steps are, of what you can do. Did you let them know that you're able to do taxes in other states besides Utah? I'm in South
yep,
Carolina, so.
yep. Yeah, our firm has clients in, I think, every state in the United States. So, we can help anybody here in the US. So if you need help, if you have questions, I'm available. My busy time starts a week from today. So if you have questions, if you could send them by this weekend, I'll get back to you before I get to the point where I'm pretty swamped. But I appreciate the opportunity, Danielle, to kind
I
of
just
speak to your
appreciate you
group.
doing this. I really do. I trust you completely, but I also know what it's like to find someone that is not so great. So you had to fix it. He was like, Danielle, okay. So yeah, but thank you so much, Matt. You guys, you can contact him or just do your research. That's my biggest advice to you is find someone that is in direct sales that knows our industry because it's not like every other business. You're dealing with team building, plus you're dealing with cost of goods sold and just the average CPA, they don't necessarily know it. Poor Matt, when I told him I was moving companies, he's like, all right, great. Well, you're going to have to teach me the new one, so he's willing to learn our company and I appreciate that. So,
Gotta get down. It's taken me quite a few years to kind of learn your ranking in your last one, and so now I got to learn another one. So
well, I'm telling you, it's very simple here. So
yeah,
yeah, it's
I
a lot simpler and a lot smaller company. I think we have about 8,000 active consultants in the US. They're looking to
all
go
right.
into Canada soon. So we are kind of on this side of the explosion. I know that you worked with several of them prior to the other company exploding. So we're on this side of it. We're getting ready. We're buckled
Well,
up and
good.
ready to go. So Matt, I appreciate you so much. And you guys, they're all saying thank you too. So I appreciate you.
Well,
I will put this recording in the groups for you guys for replay, and hopefully that helps. All
okay.
right.
All
Thanks,
right.
guys.
Have a great rest of your day.
Thanks, Matt. Appreciate you.
Yep, me as well.